Welcome to day 4 of the online comprehensive course on valuation and valuation standards for members of the Institute of Chartered Accountants of Nepal. Without any delay, I would like to invite our speaker and start with our today's session. Our speaker for the day is CA Parag Kulkarni sir. CA Parag Kulkarni is a chartered accountant from India, England, and Wales. Additionally, he has also completed his CPA exams from United States of America. He also holds high honors from NYU Stern Business School, where he was assessed by valuation guru Aswath Damodaran. He is a registered valuer. He has also been awarded with Chartered Surveyor from Royal Institute of Chartered Surveyors. Presently, he is working in the field of valuation, IFRS, and corporate finance in India, USA, and Europe, and heads Kulkarni Inc. and in AS Lab. He has written numerous technical content on valuation and IFRS and addressed many national seminars for ICAI. Thank you so much, sir, for gracing us with your presence. We are delighted to have you and enlighten us on this topic. So, over to you, sir.
Thank you so much. And it's first of all, profound welcome to our uh, Nepal's chartered accountants, which obviously represents a congregation of financial architects. And we all know that when we delve into the valuation, where the every decimal point and every ledger entry contributes to the symphony of economic prowess, right? So as we embark on our journey onto the intricate world of valuation, first of all, allow me to echo the sagacious words of the Peter Drucker, who was one of our professors in the Harvard Business School. He once opined that strategy is not a lengthy action plan. It is basically evolution of central idea through continually changing circumstances. And these words akin to financial scripture basically hold a particular resonance as we delve into a strategic tapestry that intertwines economics, finance, and science of valuation. So allow me to share my screen first of all. And let me know once screen is visible to all of you. Just a second. Let me go to PPT. Is it visible?
Yes, sir, your screen is visible.
Okay, excellent. Uh, so I think South Asian economies are doing extremely great. Indian economy has crossed the benchmark of 4 trillion USD GDP, and despite the challenges worldwide, primarily coming out of the inflationary trends and higher interest incomes, I think South Asian economies continue to do well, specifically Nepal and India. So basically, this economic narrative resembles to me, like a chessboard where strategic moves and nuances tactics unfold against a backdrop of global economic dynamics. India akin to, or the South Asia akin to, let's say, Queen, gracefully navigates these complexities, holding its grounds against opposing forces of interest rates and inflation, and akin to formidable bishops making every move crucial. So sometimes when somebody comes to us and says that, okay, we want to play a game of valuation, we are a startup organization, and our valuation is, let's say, few crore rupees or few million dollars, then obviously it looks to be like more of a am I somebody who is in the field of valuation, but in reality, is it like a financial Game of Thrones? So if this financial game in this financial Game of Thrones, where basically stakes are high and the global economic forces align like all these chess pieces on the vast board, you and I, who are the financial tacticians, dissect landscape of valuation. And it's a terrain, where the strategy isn't merely a catchphrase, but basically a captain of our economic vessel. And we need that particular strategy to steer us through the turbulent waters of fiscal policy, monetary shifts, and global economic dynamics. So obviously, objective of today's session is to uh, understand various approaches. But while we do so, I thought to do it in a less conventional manner. It's always easy to go back and look at the books and read the approaches as it is, but it's very difficult to look back at them and apply them in reality. So in that context, I personally believe that it's always good, to learn the language of valuation by actually performing the case study. So with all of you, I'm going to do a case study at the end. Before that, I'm going to give you a lot of commentary in terms of the ICI valuation standards, and one of the standard, obviously, it speaks on the approaches, etc. My agenda is to cover first, second, third, and fourth point in today's session. And I'm very sure that the moderator and all of you would have many more questions, and hence we are going to keep large amount of time for that Q&A as well. So let's go to the first slide. And it's a quick background. The Institute of Chartered Accountants of India, recognizing a need to have the consistent, uniform, and transparent valuation policies, and obviously also to harmonize diverse practices which were in use in India, it constituted Valuation Standard Board, and they constituted it on 28 February 2017. And by 2018, the board not only formulated the standards, but also actively discussed its relevance, deliberated on its utility, and adopted nationally. The objective of issuing valuation standard is also to standardize various principles, practices, and procedures, which are obviously now followed by registered valuers. And of course, some more other valuation professionals in valuation of assets, liabilities, or businesses. The valuation standards set out what? Valuation standards set out concepts, principles, and procedures which are generally accepted internationally, having regard to legal framework and practices relevant in India, as well as obviously, now the South Asian economies. So ICAN valuation standards, we believe that they are absolutely high quality suited standards for South Asian economies, considering its contextual application of qualitative characteristics such as relevance to developing economies, or maybe materiality which which arises from domestic currency, and reliability to currency's authority, or maybe a faithful representation to domestic investors, or sometimes even a substance of the agreements under the local laws, maybe neutrality and unbiasedness to foreign stakeholders, and mostly the prudence in terms of capturing risk, and completeness in terms of the conclusion of value. Globally, we need fair valuation to identify considerations under various situations like mergers and acquisitions, or maybe during the situation such as pandemic to assess the impairment, and regularly for financial reporting purposes such as valuations of derivatives and hedging instruments. Nevertheless, we all can agree that despite localization of global economies, we need cautiously curated domestic laws, not only to govern, but also to empower local business needs. Developing countries have external borrowings, right? And obviously, it is going to impact the credit rating of the country and thereby availability of the foreign cash flow. We need valuation standards that blend between international needs, local expectations, and something that truly can empower country's ecosystem. So this is the background. And we are going to translate this background into a structure of valuation standard. Before we delve into valuation approaches and methods, which is ICI Valuation Standard 103, let's look at the overall framework. We have the preface, then we have a framework, and then we have ICI Valuation Standard. They are in the range of hundreds, like 101, 102, 103, which are basically general valuation standards. Then they also are in the range of 200, which is 201 and 202, which primarily takes care of your scope of work and reporting and documentation. And then in the series of 300, we have very specific, specialized or customized valuation standard. The first standard, 301, gives a detailed guidance on business valuation. 302 gives a detailed guidance on intangible assets. And 303 gives detailed guidance on financial instruments. Obviously, our majority of the discussion is towards Valuation Standard 103. But do you all agree that reading Valuation Standard 103, Valuation Approaches and Methods, would not suffice the purpose unless we read it in a context along with 101, 102, 201, 202, and at least 301? So we can't just treat valuation approaches unless we apply it to perform a business valuation. Am I right? So let's do one thing. Let's assume that we are going to learn approaches not in an isolation, but rather in context of a business valuation, or in context of, let's say, intangible asset valuation, or in context of a financial instrument valuation. So valuation approach and method is common irrespective of the fact which asset are you valuing or which liability are you valuing. The approach that we are using could simultaneously be applied to business valuation, as well as to intangible asset valuation, as well as to financial instrument valuation. So valuation
Sir,
standards, yes.
I'm so sorry to interrupt you. Your video
uh,
is not visible.
Am I visible now?
Yes, yes. Thank you. Thank you so much.
Sure. So uh, what we are suggesting is the standard 103 in itself cannot be applied in an isolation. We need to apply it in context of a question from a client, from a society, from economy, from the countryside. And in that context, what I'm suggesting is the approaches need to be adopted for compliance of business valuation, or for compliance of financial instrument valuation, or for compliance of intangible asset valuation. So valuation standards by their very nature cannot and do not override local regulations, obviously, which govern the preparation of valuation report in the country. But if you follow these valuation standards, mostly you are within the four corners of professional skepticism, and also within the four corners of due care, which is one of the inherent characteristic of you and I as a chartered accountant. Let's move ahead. Let's quickly understand a difference between the international standard and ICI valuation standard. Because obviously, when you adopt these standards, sometimes somebody might come and say that your valuation is not in line or aligned to international best practices, and that could be a myth. It could only come out of the optics, but in reality, ICI valuation standards, if you follow, then valuations are also in line with the international valuation standards. But there are subtle differences. Like, for example, international valuation standard would want you to use a particular method unless circumstances require usage of multiple methods. On the other hand side, ICI valuation standards are more inclusive, more accommodative, more welcoming, that valuers can use combination of multiple methods, and you can apply different weightages to different methods, finally to narrow down your answer to a particular specific value that you believe to be a fair value, or at least to the range of values that you believe to be a fair value range, right? And the third difference, like it said, it basically make only a passing remark in terms of the information that needs to be obtained by a valuer. On the other hand side, ICI valuation standard have very specific requirement. It says that as a valuer, you must first of all collect the non-financial information, ownership details, financial information, and general information. Now let's move ahead. So domestic accounting standard of your country, I'm very sure, would typically need fair valuation in these 9 cases. And by the way, in each of these 9 cases, we have to select the method and approach to finally conclude the valuation, right? So when you do it for the M&A, it obviously more of a forward-looking information, the projected cash flow analysis, the synergies that you analyze. On the other hand side, the extreme right bottom, when you do it for the insolvency, you don't look at the forward-looking, very optimistic cash flows, but rather you look at what are the immediate cash flows. That too, there could be possibility of the bargain purchase, right? So in mergers and acquisitions, typically unrelated entities, when M&A happens between unrelated entities, then the standard on business value, a business combination, which is IFRS 3, would require you to calculate the purchase price, and you need to distribute that purchase price into various assets that have been acquired at their fair values. And we call it the purchase price allocation report. So what we are going to learn today in terms of the approach, there is a direct connection when any business combination happens. You need to identify the right approach for valuing CGUs, that is cash generating units, and also for valuing non-cash generating units, or maybe, which are non-operational assets, which are parked assets such as a surplus land. And then inside the CGU, you need to specifically identify financial instruments and intangibles separately from the typical cash generating tangible assets. Hence, the purchase price allocation report would demand you to segregate the overall consideration paid over various assets such as tangible assets and intangibles such as brand value, customer relationship, softwares, etc. South Asia is obviously hub for R&D for industries such as software, pharma, and heavy manufacturing. And many times investment in South Asian groups are sought in their subsidiaries or maybe parents in developed world. So, for example, a subsidiary of Indian software company in USA receives investment from VC or strategic investor from Singapore. Now, in such case, technologies built in South Asia are transferred to group entities in developed world. So, you are like Nepal, you have a software organization, but investor says that I'm not going to fund you in your company in Nepal. I'll rather buy out uh, the stake of your USA company where the large market is. And hence you must transfer the technology from your Nepal organization, Nepal entity to US organization. So there is a technology transfer. And when there's a technology transfer, obviously you need to value intangibles. And when you have to value intangibles, you need to identify a suitable approach for valuing those intangibles. I'm very sure we will have a separate session on intangible asset valuation, but ultimately the approach, whether you are following the cost approach or income approach, or whether you are following the multiple approach, remains the same. Okay, let's move ahead. South Asia is again a major exporter for many goods and services, and consequently entities here need to account for monetary assets or liabilities denominated in foreign currencies. And similarly, these entities often enter into hedging instruments. Hedging instruments, I hope you are aware of. It's like cross-currency swap or derivative instruments like forward contracts or interest rate swap. And your domestic accounting standard would want you to value these derivatives. So derivative valuation, though captured in 500 series in international standard and in 303 in ICI valuation standard, obviously need an approach to value it. And mostly we follow income approach or cash flow approach for valuing these derivatives. We also observed structural shift in business, right, due to pandemic. Many of the entities may have to analyze the potential impairment. And then your domestic standards, such as in India, we follow Ind AS 36, or at international level, we follow IS 36. Okay. We have to obviously perform the fair valuation. Now, when there is an impairment, the relevant question is whether you analyze that impairment by looking at the cash flows which are due in next midterm, such as 3 to 5 years, or whether you look at the current profitability and then you extrapolate those numbers. It remains to obviously the jurisprudence of the valuer or the judgment of the valuer, but the standard and our discussion hopefully will also guide you in passing a professional judgment and not just estimating something which is not reasonable or which doesn't fit within the professional four corners of skepticism benchmark. Similarly, on the liability side, when organizations issue instruments, when any organizations get a funding, let's assume that somebody says that, okay, I have raised 5 million USD investment. Now, when an entity issues instrument in order to get the funding, it issues instrument with certain characteristics. It may not be always an equity instrument. It could be a preferred stock instrument. It could be non-convertible instrument. It could be a convertible instrument. The instrument might come up with the voting rights, non-voting rights, participatory, non-participatory, etc. And then you as a valuer need to perform valuation of the instrument that has been issued. If it's not equity instrument, Ind AS 32 classifies it as a liability, financial liability instrument. Maybe you can go back and check para 8 of IS 32, which defines what is the meaning of a financial liability. And in that case, the valuation is necessary. And you need to determine what is an approach that you are going to adopt, how the Monte Carlo simulation needs to be adopted or plugged in order to capture different tranches or different options which are embedded into the host contract, which is basically the hybrid contract that is nothing but the combination of a non-derivative instrument and a derivative instrument, which gets together. where the non-derivative instrument basically represents a fixed redeemable certain cash outflow. On the other hand side, a derivative component represents uncertain dependent cash inflow or outflow. Okay, without sounding too complex, let's move ahead to the final last point. Finally, we all have to appreciate existence of business failures and insolvency proceedings, right? So we need to facilitate the valuation even for the forced liquidation, right? It could be a forced liquidation, it could be a voluntary liquidation, and it could be a transitory exchange of share. A company which is not doing good may be acquired by somebody else. So somewhere it was on the brink of insolvency, but some other party, white horse, came in and it saved the other organization. In that case, how you perform the valuation? These are all relevant questions. But all these questions have to go through very first step, that is, what is fair value? Am I right? What is fair value? And fair value is defined in IFRS 13. Let's go to the next slide. This is the definition of fair value. And you need to have minimum 6 characteristics in order for value to be a fair value. ICAI valuation standard have detailed at granular level, each of these 6 characteristics. They have explained what is the meaning of price. Even the word, it looks like a phrase of 2 words, the price. But what is the meaning of price? What is the meaning of received to sell an asset? What is the meaning of transferred a liability? Each of these components are in detail explained. But let's focus on the definition of fair value. What is it? It is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at measurement date. So one thing which is clear to all of us is not all prices can be construed to be a fair value. It needs to be that price of orderly transaction between market participant as of a particular day. So what is the orderly transaction? Now, all these definitions are already there. I don't want to, replicate which is already written in the book. I think utilize my existence for next couple of hours, mostly to, empower yourself from the practical knowledge perspective. And trust me, every other thing can be identified, can be read through the books or many other content which is available at the VSB level. While you conclude the fair value, you need certain inputs. You need a process, and then that's how you conclude. There is an input, you process the input, and then there is an output, and you say that output is a fair value. But in order to get an output, you need an input, right? And on the quality of input and the quality of process, the quality of output lies. So the quality of input is segregated into 3 levels: level 1, level 2, and level 3. Level 1 input are considered to be really great inputs because they are really observable. But that doesn't mean the level 1 input value is more fairer to level 3 input value. All values concluded either by using level 1 or level 2 or level 3 are fair values. However, the quality of the output can be then further analyzed on the basis of the level of input that has been used. So when somebody says that I have used level 1 input in order to calculate fair value, I would say great, because this is something which was observable in the market. And which market? An active market, not dormant market. Like a share price of a listed company. A share price of a listed company is a quoted price. And it's a price of an active market because it is routinely transacted. Now, if I observe that price, then I say it's a level 1 input. Level 1 inputs are great inputs, and auditors love level 1 inputs. But if you are valuing unlisted entity, how will you get a share price value of unlisted entity? Obviously, you can't get the level 1 input. Then you have to ultimately resort to either level 2 or level 3 input. So what are level 2 inputs? Level 2 inputs are those inputs which are other than quoted prices included in level 1, but they're still observable. So it's still an active market but it's not a quoted price. So it's other than quoted price within level 1 that are observable. Usually we call it, usually the derivative valuations are level 2 inputs. Often derivative quotes are available with the banks, but they are not traded in between the parties. Derivative quotes are exchanged between the bankers and the recipient. So derivative valuations are typically referred as level 2 inputs. And then the cash flow projections that you do and discount are nothing but management supplied projections. So these are management supplied projections, right? These management supplied projections are nothing but your level 3 input because they're not observable. Your client gives you numbers. Your client gives an estimation of revenue, cost, profitability, asset, working capital, pricing, B2B cycle, consumers, suppliers, and whatnot. These inputs are given by whom? These inputs are given by client. And these inputs are unobservable. Does it mean that the value concluded on such inputs is not a fair value? No. The value concluded on such value is still a fair value, but we have to disclose the fact that my fair value has been concluded on the basis of level 3 inputs, right? Okay, great. Now, which input should you use? What is the guidance about it? ICI valuation standards require that valuer should maximize the use of relevant observable inputs and minimize the use of unobservable inputs. In short, if you have an ability and access for level 1 input, you should not manipulate the fair value conclusion by utilizing level 2 or level 3 input. You must in that case utilize only level 1 input. Only if the level 1 input is not available, search for level 2 input. Only when the level 2 input is also unavailable, then go for finally level 3 input and then conclude the fair value. I hope I am very crystal clear in terms of now the meaning of fair value and the level of inputs which are typically used in concluding the fair value. With this, the next step is to understand the process of valuation. Like I said, we just discussed on what is the meaning of fair value, which is the output. But in order to reach the output, we need to discuss input, which we have just discussed about level 1, level 2, and level 3. And now we have to discuss on the process of fair valuation. Let's move ahead. Okay. The process is 8-step process. First, identify the asset under valuation. Is it asset or is it a liability that you are valuing? Have you heard anybody valuing liabilities these days? Yes, even liabilities are subject to valuation. When you follow the net asset method is nothing but valuation of assets minus valuation of liabilities. Now, sometimes and often we assume book value of liability to be a fair value of liability, but that's nothing but level 3 input, which is unobservable assumption that the book value is equal to the market value. However, you are expected to even perform valuation of liabilities. I'll quote an example where you perform valuation of liabilities. When any organization issues, let's say OCPS or CCPS, preferred stock, or convertible instruments. Now they need, when they classify that instrument to be a liability, IAS 32 require and IFRS 9 require you to recognize the initial recognition of financial liability must be at fair value. You go back and check IFRS 9. And if you want, I can also give you para reference. If I'm not wrong, the recognition is discussed in chapter 3 of IFRS 9. And in chapter 3 of IFRS 9 and in chapter 4, where classification of financial liability is discussed, if you go back, you would read chapter 3 and chapter 4 together. It says that the initial recognition of financial liability must be at fair value. Similarly, initial recognition of financial asset must be at fair value. So first, identify the asset or liability. Then secondly, understand why are you doing the valuation? Is it for the compliance purpose under a particular act, taxation, or are you doing it for the deal making? Then perform the analysis. And obviously, you perform the analysis by understanding the nature of the instrument and feature of the instrument, nature of the asset and features of the asset. The nature is what? Long-term, short-term. Features such as voting, non-voting, participatory, non-participatory, with liquidation preference, without liquidation preference, recurring, non-recurring, etc. Once these first three steps are concluded, then you are empowered enough to pass a judgment to understand a valuation base. Do you want to identify a fair value for the reporting purpose? Or is it for the deal making where you must capture even the synergies and some other points where you have to calculate market participant specific value? Or is it for the insolvency purpose where you have to identify the liquidation value? So first four steps will basically give you a clarity in terms of what is required to be done. And only when you have that clarity, then comes the question of today's topic, which is valuation approach. So can I assume that all of you have base level understanding of first four steps that needs to be concluded? And by the way, you can please, a message in the chat. I'm not really sure if your chat can come to me, but if you have any question, or if you want to discuss anything, if you want to raise a voice, or if you want to also contribute to what I'm sharing, please type in the chat. It's always good, to have this two-way communication instead of a monologue. Okay. Now let's speak more on the valuation approach. There are typical three valuation approaches: income approach, market approach, and cost approach. And obviously, we are going to understand each of these approaches in detail. And I'm not going to give only theory about it. At the end, like I said, I'm also going to give you a detailed case study so that the knowledge sticks with you. It becomes ingrained into your brain and blood. In income approach, obviously, we utilize the income of the organization. What is a forward-looking income? What is a forward-looking cash flow? It's a free cash flow. And typically, we use free cash flow for firm or free cash flow for equity holders. Anyway, even if you don't know these technical terms, that's perfectly fine. Just stick to, the overall knowledge decipher that is happening now. And trust me, you will be good to go. Next thing. Once the valuation approach is finalized, then you go for the modeling. Inside the model, you go, there is a detailing. Detailing basically make you a professional. Otherwise, even computers can do the work. Otherwise, non-professionals can also do the work. So detailing happens in the modeling. Like in terms of the income approach, we need to go deep dive into the cash flows. We need to go deep dive into discount rate. And we are going to perform small exercises as well if time permits. In the market valuation approach, we need to again, look at external databases and look at the observed revenue multiples, EBITDA multiples, EBIT multiples, EPS and PE multiples like this. And only when these first six steps are finalized, then you would say, okay, there is a conclusion of value. And that conclusion is often at a controlling level, or then it needs to be translated to non-controlling level by applying discount for lack of control. And if the company is an unlisted entity, then you have to also then convert that value to value for the unlisted entity by applying the discount for lack of marketability. The entity which is unlisted entity has less liquidity or less marketability as compared to entities which are listed organization, right? And once you have reached to this conclusion of value at a particular level, for example, when you are doing valuation for ESOP, employee stock options, obviously employees are never going to get control. So your value should represent a non-controlling value. On the other hand side, for the deal making, if somebody is acquiring 51%, your value should represent the control value, right? Once you conclude the value, then comes the reporting and documentation. And that reporting and that documentation must be decision-centric. It should not be theoretical. Obviously, there is a minimum content requirement that has been given by valuation standard, but you need to go extra mile to ensure that there is a quality to conclusion and there is a utility to conclusion of the value. Otherwise, it still just remains a number on a piece of paper. Fair value is finally a fair value when it is transacted at that value. Otherwise, fair value is just a value on a piece of paper, right? Okay. Now, I'm going to take a step back here, and I'm going to give you my commentary in terms of the conclusion of value, because it is very important, very, very important. Let me tell you this. So valuation standard framework, empowers valuer to set value in a context. Minimum content requirement helps valuer to articulate report in a logical hierarchy. Okay, this is very important. And then in the reporting, we need to bring the macro outlook. How is the GDP of the country? How the industry is doing? Then how much share company has out of total industry, whether you are a market leader or whether you are a market follower. Whether when you do the analysis by applying the Porter's 5 forces, basically we analyze, is it supplier driven market, is it consumer driven market, is it monopolistic market, is it oligopolistic market, is it a perfect competition where you have to only maintain the bare minimum margin, and hence the penetration happens only through supply chain management or through deep pockets of consumer. So this value in context is important. Same organization may have altogether different less value irrespective of the same cash flows, because they may not have access to your deep pockets on a geographical level, or they might be a dying organization, right? Or they might have the same margin as a percentage, but your cost cash flows are larger because of your volumes. So that value in context is important. Then the second is this high quality independence. So value in compliance with valuation standard framework portrays economic decision making that need, obviously, economic decision making of intended users. And this framework is also going to help you to draw faithful conclusion that are free from bias, and it should be free from all material erroneous aspects. So it should be complete in terms of the material aspects. And finally, valuation under this frameworks are characterized with understandability, relevance, and reliability. Finally, values are based on comparable transaction multiples or comparable company multiples. And we obviously will look at it as we go ahead with the session. When we say market driven prices, it's a market approach. Okay. So adoption of these standards, a framework which basically caters to practical needs of South Asian entities and simultaneously facilitates international reliable conclusion by South Asian countries, could bring demographically suitable standardization and comparability in and around South Asia. So it would help countries to build on cumulative experience and learning curves without ignoring parallel compliances with domestic laws. So it doesn't matter if you as a Nepal organization has different authoritative structure and rules and regulations. If all of us in the South Asia work in tandem and ensure the conclusion of value in context with high quality of faithfulness, neutrality, and completeness, and which is through more of market driven conclusions such as observable inputs and levelable inputs, I think we are doing really great job to the market and to our profession. Now let's little deep dive. Let's little deep dive in terms of certain issues that we have. Certain issues. Now people often come back to us and say that what is a difference between fair value and fair market value? Now come on. Sometimes your tax laws are going to refer that value as a fair market value. Sometimes your accounting refer it as fair value. See, to us, there is no significant difference, except one is a two-word phrase, another is a three-word phrase. But I believe that in heart and soul, both of them mean the same thing, that it should be real, fair, and independent value, right? So we are going to look at now the fair value framework as we go to the actual performing the fair valuation utilizing different approaches. Now let's look at the income approach first. Okay. And we are going to deep dive into the income approach first. Then we will jump onto the market approach. And I think cost approach is very easy. You all are chartered accountants. If you have any query on cost approach, obviously, I'll be very glad to answer, but I'll prefer to remain lopsided by giving more time to income approach and market approach. So let's first look at this chart on a cash flow market approach or income approach. So in the income approach, basically what you do is you capture the income, which are cash flows, and you capture discount rates. And then you use discount rate to discount the cash flows, and what you get the present value. So present value of those cash flows, we call it to be a fair value. That's a very simplistic framework. But if it is so simple, if it is so simple, anybody can do it. Even if he is not chartered accountant, or even if he comes from non-chartered accountancy background, right? Because it is mostly about using Microsoft Excel, putting up the number and discounting it. But obviously there is a science behind it. And let's look at cash flows and discount rate independently. Let's first address some of the issues in cash flows. In cash flows, we need to look at base year, growth, margins, and terminal value. Okay. Let's do one thing. Let me check in the chat box. By the way, I just need to know whether can we have participant as well as the chat box, or participants cannot interact through the chat box of this mechanism.
Sir, so the participants, they cannot, they can interact with you via us. So they will be asking questions, they will be interacting. Anything that comes up through them, I will be asking it.
Sure, no problem. So imagine an organization such as OpenAI. And I hope all of you are aware of about OpenAI. OpenAI came up with the ChatGPT, one of the brilliant AI model. And I don't know whether you heard yesterday, Google announced its AI model called as Gemini, which obviously will come to us through BART. And these organizations are disruptors. And on the other hand side, there are conventional, traditional manufacturing organizations, such as manufacturing of automobile, or let's say then other industries such as paint, pharmaceuticals, where the maturity has been achieved. So the base year for startup versus base year for a mature organization in disruptive industry versus a base year for a matured organization in non-disruptive industry or a conventional or traditional industry, they all can't be one and the same. And if they are one and the same, then obviously the growth rate needs to be different for differing years. Now, if all of us say that there is particular organization which was incorporated in year 2019 or 20, when COVID hit, can we consider year 2020 to be a base year? We can't do that, because there are certain IT companies like Zoom or Microsoft Teams, which applications received tremendous growth primarily because of the acceleration of digital activities. Now, acceleration of digital activity happened, that's okay. But when people started going back to offices, the volume of Zoom call also dropped. The volume of team call also dropped. The volume of the digital communication also dropped. On the other hand side, hotels and restaurants, they performed so poorly. Or airline industry, they performed so poorly during pandemic. Can it be a base year? No, it can't be. So one thing we all conclude is, though income approach is one of the approach that can be adopted, it must be adopted logically. So that common sense and logic must be applied in both cases, in cash flows as well as the discount rate. So what is your base year? That's the first question. And on that basis, then you need to imagine what is a growth. If somebody is showing me his figures for 2019 and significant revenue growth, let's say it's a tech organization, a significant revenue growth, by the way, okay, for year 2020 and 21, then I would attribute that success to the acceleration of digital companies, which happened during that time. And on that basis, if he believes that he is going to get significant growth, like 50% upside on year basis, even for next 3 years, I'm not going to buy out that argument, because it's a faulty base year. Similarly, sometimes margins are higher when you're a growing organization and when you have a newer product. On the other hand side, when competition increases, when you need to seek a growth, then you need to penetrate by using the price penetration strategies. Or sometimes you need to work in negative margins because though you have an operating positive margin, you need to invest heavily in marketing. And in some other cases, you have to invest heavily in research and development. Look at the case of Facebook, what happened. And if time permits, maybe I'll also take a case study on Facebook and I'll exactly show you what happened to the Facebook. Facebook invested heavily in the Meta platform. And if you want to Google now, go back, okay? Google Facebook price from year 2019 onwards. See what happened. When they started investing a lot in the Meta platform, their stock price slumped down because free cash flow available to them was less, and Meta didn't come out to be another disruptor. We all originally believed just during the pandemic that the Meta would be something really big. But did it really happen? No. Meta was not like an iPhone like of event, but rather ChatGPT definitely was one of the disruptors. What we all assumed to happen on account of Meta didn't happen. And the shareholders of Facebook, observable input, level 1 input, the quoted prices, the shareholders of Facebook did not agree to pay more for the price of Facebook. You can go back and check live on the Google now that the Facebook price depleted sharply after the pandemic. I mean, during the pandemic, it depleted and then it suddenly jumped up because everyone believed that it's an acceleration of digital activity and the Meta will jump up like anything. No, it didn't happen. Slowly it came down. But stock pricing of as Meta came down, even the stock price of many other digital companies came down, except Apple and except Microsoft. By the way, Apple and Microsoft continue to do well even now. So the value conclusion is a combination of cash flow as well as the discount rate. It's not a very simplistic value conclusion. It's not a singular value conclusion. It's a very complex and dual value conclusion. There could be offsetting impact. The cash flows may be great, but the discount rate is also higher. Or the cash flows are not so great, but discount rate is less. Let's go back and let's pause for a moment. Let's understand what happened immediately after the dot-com bubble. Do you remember the dot-com bubble of 2000? After the dot-com bubble of 2000, the stock market crashed. And when the stock market crashed, like presently USA is having the inflationary market, and that time it was a recessionary trend. And President Bush comes on the national television and says that every American should have a dream of owning a home. And he created two organizations, Freddie Mae and Freddie Mac. How is it relevant to us for the valuation? It is definitely relevant for the valuation. He created two organizations and through fiscal policy and monetary policy, he started pumping money inside the economy. Higher the money flow, higher the purchasing power. Simultaneously, bankers started reducing the interest rate. So we have a combination of higher cash flows and lower discount rate, which obviously augmented the overall valuation, and that resulted in a subprime crisis when the interest rates were reversed in year 2007. In year 2007, the marketability of the same house, which was once valued at 2 million, was suddenly reduced to 1.5 million. And people said that, oh, the value of my house is no more 2 million. I have borrowed 1.8 million. So I have realized 1.8 million in my hand. But now the value of house is only 1.5 million. So let me do one thing. If I go out in the market and sell my house, which is mortgage to the bank, I'll get only 1.5 million. Instead, banker have already given me 1.8 million. So let me go ahead and default. So that it was a kind of, sale to a banker at 1.8 million. So the marketability, cash flows, discount rate, they all work in tandem simultaneously in order to get a value conclusion in that context. The macroeconomic indicators, the industry indicators, all these needs to be taken care of. And then comes something like COVID-19. And in COVID-19, the real question when we were performing valuation, when we adopted income approach was, should we adjust the cash flow or should we adjust the discount rate? Should we support our valuation additionally through sensitivity analysis? Or should we adopt the Monte Carlo simulation? And irrespective of doing everything, still the value conclusion was questionable. Because at that point in time, no one was aware whether the economies will recover, whether the countries will recover from this pandemic. And similarly, when the Russia-Ukraine war hit, what happened? Everyone, all markets, all stock markets collapsed. Similarly, when the Palestine Israel war was triggered, and when USA declared that we are going to support Israel, and when the China said that we are not going to support Israel, again the stock markets were hit. No, yesterday the war was not there. Same cash flows. See, understand the difference. The difference is that your cash flows are not impaired. Your ability to generate cash flow remains the same, but the discount rate has undergone a change. The perception moved from optimistic to pessimistic, and hence bankers across the world started increasing the interest rate. And you go back and Google now what is the bond rate of your country, or bond rate, let's say Indian 30-year bond rate, Indian 10-year bond rate, or USA 10-year bond rate, and what it was, let's say 3 years back. You would see all these bond rates have significantly increased over the last couple of years. So when cash flows remain same, but the discount rates are increasing, obviously the valuation goes down. Am I right? So adoption of income approach is not only a mechanism of performing discounting in Excel. It's a matter of professionalism. It's a matter of intelligence. It's a matter of picking up the observable inputs. And it's a matter of professional conclusion, obviously with a lot of adjustments. So let's do one thing. Let's move ahead. And now let me give you some more commentary on maybe the market approach. So this was my, by the way, base commentary on income approach. I'm going to once again go deep dive even on the discount rate, which I have not done as of now, but I have a separate slide for it. So don't worry. It's not that I'm skipping something. We are going to do, detailed analysis on this as well. So don't worry. Okay. Let's move ahead now. And let's look at the slide. I'll give you 20 seconds while I drink my water. Read out the slide. Okay, yourself. So I'm giving you maybe 30 seconds to think about the process of valuation. Okay, I'll take a 30 seconds break here. Think about it, and we are going to discuss on the market multiple approach. Okay, I hope you are ready to have my monologue of next maybe 30 minutes or so. IFRS 13 states that when measuring fair value, the objective is to estimate price at which orderly transaction. See this orderly transaction. Okay, orderly transaction. Yeah, so let me come back once again. IFRS 13 states that when measuring the fair value, the objective is to estimate the price at which orderly transaction to sell an asset or to transfer a liability will take place between market participants at a measurement date under current market conditions. Current market conditions is that is exit price. By the way, I'm just giving you some some backend information. The information is that when the subprime crisis happened in year 2007, AICPA, FASB, and ISB all were blamed. They were blamed that you already have so much of good accounting standard and valuation standard, etc., etc. But still the crisis happened. How you could not anticipate the crisis? Why it was not properly reported in the accounting? And then that time we had accounting standard called as IAS 39 on financial instrument. And that time the definition of fair value was something like arm's length transaction. Okay. So then while we evaluated the definition of fair value, and then there was a separate project when we moved from IAS 39 financial instrument to IFRS 9 financial instrument, now the new definition of fair value captures the concept of exit price. Okay. The exercise might be similar to those situations when an entity has to make other estimates of financial reporting purposes, such as measuring provisions like in IAS 37. And in many cases, financial reporting measurement will involve uncertainty, right? Uncertainty about timing or amount of future cash flows. You really don't know when will you realize that money. That kind of uncertainty about, you know that the money will be realized, but you don't know the amount of future cash flows. Okay. Okay. Now, obviously, which means when there is uncertainty as a valuer, you need to pass a professional judgment. And judgment is involved not only when. So, see, there is a two-step process. First step is which technique to apply. There is a judgment. So, there is a selection of valuation technique. You need to apply the judgment. But once you select the valuation technique, even when you perform the valuation, then again, while performing the valuation, you need to pass a judgment. Because there are, uncertainties around the timing and amount of future cash flows. Okay. For example, maybe, an investor is likely to place, let's say, more emphasis on comparable company peers, or when, the background or details of the observed transactions. And hence, maybe with the observable transactions, the judgment may be less. But for, let's say, reporting purpose, you may not have all those data available. And then you might end up relying more on the unobservable inputs, that is level 3 inputs. But as a professional, like I said, you must always emphasize on utilizing more of level 1 inputs. Okay, let's go ahead. Similarly, an investor is likely to place more emphasis on discounted cash flow method when the cash flows of investee present unique characteristics such as periods of, let's say, unequal rates of growth. For example, period of high growth, and then over the period, then it stabilizes with the more steady level of growth. So investor would say that, okay, if one company is a matured organization, then I would rather prefer the revenue multiple and EBITDA multiple. But if the company is a growing organization, then your current revenue doesn't represent the true value of the company. So utilizing market multiple approach, or let's say revenue multiple, may not be a right technique for growing organization. When you know that my revenue is going to be, let's say, doubled or tripled in next 2 to 5 years, it is rather recommended for you to pass a judgment and apply the DCF approach or the income approach. On the other hand side, if you know that if the growth is not a volume growth, it is more of a price inflation growth, you're not going to capture more geographies and more consumers. It's a very kind of perfect competition, and your market share. The market is also not growing. In that case, it's okay to use the market multiple methods such as revenue multiple. So then again, there is a judgment. I'm preferring to use the market multiple in such scenarios, and I'm not preferring to use the revenue multiple or EBITDA multiple in those cases. So selection of an appropriate method is very important. You need to pass a judgment in that cases. Okay, let me speak something on dissimilar results under different methods. So what happens when you get dissimilar results? Your revenue multiple is showing one number, your EBITDA multiple is showing altogether another number, and discounted cash flow is showing fundamentally different number. what will happen? So I'll tell you, the challenge is you are a company with, let's say, a revenue of 100 and let's say EBITDA margin of 20%. And your competitor, okay, has again the same revenue level, revenue of 100, but margin of 50. Now you tell me who should be valued more? Should you be valued more or should your competitor be valued more? Obviously, you should be valued more because at the same revenue level, you will have higher margins and your competitors with the same revenue level have lower margins. So if you tend to value your organization on the basis of revenue multiple, you will also tend to value competitor organization on the basis of revenue multiple. So multiple is same. Let's say multiple of 3 is applied. Now because you have revenue of 100, your competitor has revenue of 100, both of you are valued at 300. Now that's wrong because when you apply discount rate to the cash flows, your cash flows are better than his cash flows. So valuation that you are getting under cash flows is 350, which is different from your revenue multiple. A judgment lies in which method should you apply and which method is a better method. Obviously, in a given case, if you are applying multiple of 3 to the competitor with margin percentage of 15%, you must calibrate that multiple in such a manner that your valuation should logically be more than your competitor's valuation at the same valuation level. And hence the DCF valuation is giving those results. So the calibrated multiple that you should have applied should be 3.5 and not 3, which then gives you similar results under DCF approach and under revenue multiple approach. And we can go on discussing. We can discuss on EBITDA multiple techniques. We can discuss on maybe P multiple techniques and likewise. So let me also speak about, the valuation of some of the unquoted entities and then certain adjustments. So investor is likely to place, like I said, more emphasis on discounted cash flow method when your organization represents unique characteristics such as high growth that ultimately will stabilize. So at a high growth company using today's revenue and multiplying current multiple is wrong. Then you have to look at the forward revenue multiple or you have to apply it on the forward revenue because tomorrow's revenue will be higher. And then true potential is represented and captured by tomorrow's revenue and not by today's revenue. So if you utilize today's revenue and apply the multiple of 3, you will get a valuation of how much? 300. But you apply, but if you utilize, let's say tomorrow's revenue of, let's say, 120, and then you apply a multiple of 3, then you get a valuation of 360, 120 into 3, right? So let's come back. When measuring the fair value of unquoted instruments, an investor might conclude that on the basis of specific facts and circumstances, for example, on the basis of history, nature, then stage of the development of the investee, the nature of the investee's assets, it's all challenging. Now let me do one thing. Let me give you another slide and just look at the slide and internalize the content of the slide and think through on my commentary what I have given you. Think about it for, let's say, 20-30 seconds, and then I'll come back and we will discuss on the hierarchy of valuation. Have you internalized the content? See, IFRS 13 does not contain a hierarchy of valuation technique, nor does it prescribe the use of specific valuation technique, obviously for meeting the objective of fair valuation. So don't be under impression that value conclusion under level 1 is located at a better hierarchy than value conclusion under level 3. No. uh, it only represents the fair value conclusion by utilizing level 1 versus level 3. So when we are looking at for the deal making, I would obviously prefer to rely on value conclusions on the basis of level 1 inputs than level 3 inputs, right? Obviously. But like I said, there is no differential hierarchy of valuation. There is nothing called as this is better fair value than the other fair value. If the value is quantified in accordance with IFRS 13 and by following valuation standard, it's a fair value. That's it, full stop. Right? So there is no hierarchy of valuation. However, IFRS 13 acknowledges that given specific circumstances, one valuation technique might be more appropriate than other. So income approach value conclusion is better than market value approach conclusion is not what is written in IFRS 13. But it definitely appreciates the fact that in certain situations, like we discussed about a growing organization, utilizing income approach could be better than utilizing the market approach. And some factors that an investor will need to consider when selecting most appropriate valuation technique are what? First, it's the information that is readily available to the investor, what I can observe from my sources. Second, market conditions. Market is sometimes bullish, sometimes bearish, and then in the bullish market you consider different valuation techniques. In bearish market you might tend to consider altogether different valuation techniques. Third, investment horizon and investment type. For example, market sentiment when measuring the fair value of a short-term investment might be better captured by some valuation techniques by others. Okay. Fourth point as an investor, what I'll consider is the life cycle of an investing. What may trigger value in different stages of investee's life cycle? Like if I am investing in an organization with a pre-revenue, I am going to adopt altogether different methodology, because if it's a pre-revenue organization, I don't have revenue. So I can't create revenue multiple valuation, because for revenue multiple valuation, I need revenue multiple. The multiplication of the two creates a fair value, right? But if the organization is pre-revenue, like in case of Tesla, when Elon Musk floated the company, he just went on sharing the idea and people invested in him on the basis of idea. That's it. Tesla was loss making for initial so many years. So how can you utilize projected losses and perform the valuation utilizing the positive value for negative, for loss making companies over the next 10 years? Tesla, after 15 years, captured the value. And forget about just automotive vehicles. Look at look at the X, their work in astronomy and their work on all these this spaceship and space missions. Initially they all were loss making. There was no revenue. They were only experimenting, and investors were pumping money only in R&D. Then can you apply the market approach? No. Can you apply the income approach? Maybe. But like I said, you need to pass a judgment. So as an investor, obviously there are 3-4 things which I would look at. Then fifth point, what else should I look at in passing a judgment, in selecting the most appropriate valuation technique? The fifth point could be the nature of investor's business. For example, it could be volatile in nature. Look at the manufacturers of umbrella, cyclical in nature, right? You buy umbrella only when there's a heavy rainy season. You just don't go out and buy raincoats every month. Similarly, you don't buy school bags every month, right? You don't buy premium clothing every month. And look at even the tourism industry. It's also cyclical, right? So hence it might require higher working capital in some time and lower working capital some other time. Okay, now the last point, which I'll consider if I'm an investor, before I'm selecting the most appropriate technique. The industry in which the investee operates. Okay. And obviously there are three approaches: market approach, income approach, and cost approach. Fair value measurement of equity instrument must reflect current market conditions. An investor might ensure that valuation techniques reflect current market conditions by calibrating them at a measurement date. But at initial recognition, if transaction price represented fair value, and an investor will use a valuation technique to measure fair value in subsequent periods that uses unobservable inputs, then the investor must calibrate the valuation technique so that it is equal to the transaction price. Let me give you some more commentary here. Sometimes when the deal happens, it just happens. Now, can we assume because the deal happened between unrelated parties, it's a fair value? You may not. Okay, you may not. Because in hindsight, you may end up realizing that, okay, I have overpaid. And oh my God, I shouldn't have paid so much money to him. I paid, let's say, few crore. Let's say I paid 1 million USD and I got 20%. But they're not really doing good. I overpaid them. When I say I overpaid them, which means the fair value what they quoted to me was not fair to me. It was unfair to me. And hence the deal value was not a fair value, but was a unfair value. But we realize the fairness of value only in hindsight. Subsequently, we realize that when we perform the assessment, right? Similarly, sometimes it also happened that, oh my God, I paid 1 million, I got 20%. It was a cheap throw. Now, today's my valuation of 1 million is, let's say, 7 million USD. So, which means you underpaid him. So, when the deal happens, or when you go out, or when the stock market prices, so that's the reason we don't call stock market fair values. We say stock market prices. And price is fundamentally different from a fair value. Out of many different prices, that price which fulfills the definition of fair value is a fair value. Are you getting my point? Okay. So I spoke about the calibration. Maybe I'll speak for half a minute on this slide. Okay. Maybe, on the last paragraph. Due to nature of inputs used while valuing unlisted entities by applying discounted cash flow method, or let's say for performance measure, when you apply comparable company valuation method, multiples, and the relevance in the resulting fair value measurement, then what happens? Most of the resulting measurements will be categorized as level 3 of the fair value hierarchy. So accordingly, such fair value measurements will require additional disclosure. IFRS 13 would want you to give additional disclosure when you have used the level 3 input. And such disclosures provide user of the financial statements with information that is more relevant for him for his economic decision making. So the only takeaway here is that irrespective of the fact, whichever approach that you choose, if you are utilizing or relying heavily on the level 3 inputs, then you must give additional disclosure so that he can perform his value conclusion in a context. Okay. And if required, maybe he can go ahead and apply some of the other calibrations and some of the other adjustments to the value that you have concluded for his decision making. Okay. Now let's a little deep dive into the approach and then technique. Okay. So under each approach, there are techniques, right, that we can adopt. So I hope you are ready to little deep dive into the valuation approaches now. On the left-hand side, we have valuation approaches. On the right-hand side, we have valuation techniques or valuation methods inside each approach. So for example, when I say I have applied market approach, what does it really mean? Does it mean I applied the comparable company valuation multiple, or have I applied the transaction price paid for the identical or similar instrument of an investor? Secondly, so comparable company valuation multiple, and there is also some other third point which I have not written here, but third bullet could be comparable transaction multiples or a deal values. So if your competitor got the deal value of some number, then obviously that multiple we can use, or you can refer to or observe revenue multiples of companies which are listed, okay, which are listed in the country, let's say in New York Stock Exchange or a national stock exchange, or let's say on Singapore Stock Exchange. And then you can calculate their multiples, revenue multiple, EBITDA multiple, P multiple, and then you can apply it to your unlisted organization to conclude the value. So that's a market approach where you observe the market data, and on the basis of those observations, you conclude. The second approach is income approach. I think we have heavily discussed this, but inside the income approach, there are 3-4 different methods. One is discounted cash flow approach, discounted cash flow method. Second is dividend discount model. Third is constant growth model. It's a constant growth dividend discount model. Okay. And one is the annuity model, which is also referred as a capitalization model. And then last is the cost approach, which basically is the adjusted net asset method, or you can also use a combination of approaches. You can obviously use that for valuing one of the segment. You can rely on a cost approach because it's a non-operating segment. Let's say it's a surplus land, then obviously you can go ahead and observe the market price and adopt it. If it's a land which is purchased recently, you can apply the cost approach. And for performing assets, for cash generating assets, you can apply the income approach. And maybe for certain assets which are liquid in nature, you can apply the market multiple method. Okay. So let's move ahead. Now let's discuss the market approach. So read these two techniques for a minute, and then I'll give you my commentary around it. I hope you got sufficient chance, to read time and again the technique 1 and technique 2. Let's go a little deep in this. The market approach uses prices and other relevant information that have been generated by market transactions that involve identical or comparable assets. Number of techniques are consistent with the market approaches. The market approach techniques which are most commonly referred to for valuing unquoted equity instruments are related to data sources that they use. For example, quoted prices of public companies or prices from mergers and acquisitions. Let me repeat. You can either look at listed organizations and look at quoted prices of listed organizations, or you can look at the deals data. That is, you can look at the mergers and acquisition deals data and then identify multiples out of it. So all in all, there are two techniques. Technique one, transaction price paid for identical or similar instrument of an investee. Technique two, comparable company valuation multiples derived from quoted prices, that is trading multiples, or from prices paid in transactions such as mergers and acquisitions. Okay. Now let's go a little deep. Let's go into technique one. What is technique one? Transaction price paid for identical or similar instrument of an investee. Let me subdivide this discussion into two parts. Part one, transaction price paid for identical instrument of investee, and part two, transaction price paid for similar instrument of investee. So let's first discuss part one. When instrument is identical. So when an investor has recently made an investment in an instrument that is identical to unquoted equity instrument being valued, then the transaction price, that is entry price, might be reasonable starting point for measuring the fair value of that unquoted equity instrument. So let me explain you what it is exactly. Let's say there is an investor to whom you issued 1 million USD worth shares. Okay. And you diluted 20% of the stake. So let me give you a number once again. There is an investor who invested 1 million in your company, and you diluted 20% of your stake. Tell me, what is your valuation? I mean, 100% valuation. If the 20% stake is valued at 1 million, apparently, mathematically, let's, ceteris paribus, forget about other complexities. Apparently, the valuation of your company is 1 million into 5, which is 5 million USD, correct? Now, if you are giving your employees employee stock options, do you need to perform valuation once again by looking at the cash flows of the organization? May not be, because already there is an identical instrument which has been issued. It's an equity instrument that you have issued to investor, where you diluted 20% by getting 1 million, which means the valuation is 5 million. So you know total valuation, which means you also know the value per share. And if you are issuing, let's say, employee stock options, or let's say further issue of shares to some other people, let's say employees or third parties or vendors, it's the same value that you can pick up. Transaction price paid for the identical instrument, it's the same equity instrument of an investee, right? So then you can quickly pick up price from there. Okay. Now, factors that might indicate that investors' transaction price might not be representative of fair value at a measurement date. What it could be? Now, I said that your investor, paid 1 million just now. But what about if there is some time period, or if some significant event happened thereafter? So significant change in performance of investing compared with budgets, plans, or milestone, then obviously, then the valuation is no more 5 million. It would be different. Or if after the investment has been received, now you are expecting changes, to technical product, because investor is coming up with the technical synergy, valuation should logically go up, because now you are more empowered with, the technical prowess, right? Or the investment happened, and immediately thereafter, the pandemic hit. On 1st of January, the investment happened. On 20th of January, the pandemic hit. And then the next investment round is anticipated by 1st of February. Can you use the valuation that you used for 1st of January round? You cannot. Because there's a significant change in the global economy or the economic environment in which the investee operates. So though the instrument is identical, you still cannot refer it as a comparable instrument for subsequent round. It's not possible, because there's a change in the economic circumstances, or there could be significant change in performance of comparable entities, or in overall market. For example, let's look at the situation. There was a significant higher inflationary macroeconomic outlook somewhere during January of 2023. The market rates, that the bond rates, jumped from less than 1% to 3% and 4%. So when you issued the identical instrument, when the market rate was, let's say, 0.5% or 0.75%, and now when the market rate is, let's say, 3%, obviously you can't use the same valuation, because though the cash flows remain same, the discount rate has undergone a significant change. So yes, I agree the time period is less than 1 month. The instrument is also identical, but still it's not a comparable number to adopt as a fair value. Okay. There could also be something as, internal matters such as frauds or commercial disputes or litigation, or the matters, it could be a change in, let's say, management strategy. It's significant difference. Though the instrument is identical, you cannot still utilize the valuation. Like, somebody, IPO came of the organization, or let's say somebody invested, let's say, on 1st January. And then a few days back, 5 days back, one of the news agencies reported a fraud in that company. And it reported fraud with substance. So it's not only a news gimmick. Let's assume that yes, there is a pessimistic, view now, and let's say there are some culprits and perpetrators inside the organization. So then there's also question on the governance and the ethics and the management capability and the intentions to defraud even the previous investor. So in that case, again, the same previous transaction for identical instrument cannot be used as a representative of fair value. So in addition, investor must consider, obviously, the existence of factors such as whether the environment in which the investee operates is dynamic, like a day before, the investment is received, and you're working in automation, or let's say you're working on, let's say, you're running a marketing organization. You are, let's say, working on um, uh, uh, grammar review organization, that people come to you, they ask you to do the grammar review of the document, and then you do the grammar review and charge them on a per document basis. And what happened? Chat GPT come in. The artificial intelligence kicked in very next day. You were not aware, but you had an entire business model. And now every other person is just putting his document and asking artificial intelligence, to remove the grammatical mistake and give the better articulated content. Done. Your business model is completely collapsed. So again, the time period could be less, but the same equity instrument, the identical instrument valuation cannot be adopted because of a significant change from the previous valuation. Now, when you conclude that technique 1 is inappropriate, that this one, okay, technique 1 is inappropriate, then the more appropriate valuation technique for measuring fair value of the unquoted equity instrument is what? Use the comparable company valuation multiple or the discounted cash flow multiple. So this is part 2. Okay. So like we discussed in case of identical instruments, the transaction price paid recently for an investment in equity instrument, which is similar but not identical, can still be used. So then, this part 2. So what is a similar instrument but not identical instrument? Similar means, again, let's say it's a equity instrument but without voting rights. So previous round happened for an investment of an equity with voting rights. The next round happened for an equity instrument, which is a class B instrument, not class A instrument. And class B instrument comes without voting rights. And the third round happens not of equity instrument, but for a preferred stock, which is as good as equity instrument, but with a preference in liquidation. It's not identical instrument, but it's a similar instrument. So you can still refer to that. Okay. I mean, we can go on. I mean, I can give you commentary for next 15-20 minutes even on this slide. I can, keep on talking on this. But I hope you got the gist. You basically got what I'm trying to say. That market approach looks very simplistic. That, okay, let's look at the market multiple, adopt it and present it. It's still complex because you need to verify the comparability and the adaptability. Only when it is suitable to adopt a particular market multiple, then and then you must do so. Otherwise, you need to either calibrate or you need to, give away this approach and shift to better approach that can maximize the usage of observable inputs and still give you a value which then can be concluded to be a fair value. Okay. Now maybe let me come on this part 2. The transaction price paid for a similar instrument where 4 adjustments are necessary. And let me invest some time in discussing these 4 investments. So let's do one thing. Maybe I'll give you half a minute. Think about it, because now the instrument is not identical, it's a similar. So obviously you can't just adopt the value. You need to do certain adjustments, right? So think about it, and obviously I'll give you my opinion on those adjustments. Typically in our office, my team and myself, we work in a framework. So we do these 4 adjustments. But I'll take a pause here for 20 seconds. Let you think through. And then maybe we will discuss the adjustments that typically I do. And I also welcome your suggestion. Did you get chance to guess through what adjustments that typically we need to make when the instrument is similar but not identical? I'll tell you. The first adjustment, numerical adjustment and qualitative adjustment that we need to do is to reflect differences between the qualitative characteristics, such as a difference between preferred and ordinary shares. That is an adjustment that to reflect the priority of the preferred shares upon liquidation. Then you also need to perform second adjustment, that is adjustment when investor has concluded that there is a benefit associated with the control. One instrument, like the recently when investor acquired stake in your company, he has acquired 51% stake. So obviously the price that he has paid, it's not proportionate to 51% of the total value, because obviously by acquiring 51% he got the control, so he must have also paid the control premium. But if let's say you are acquiring 3% of the stake, or let's say 10% of the stake, you can't then redo the 51% value to 100% value and then multiply by 3% or 10% to calculate your valuation. That's not how we do that. Okay, that's not how we do it. So there is some adjustment where you remove the impact of control premium, you make the valuation suitable for non-controlling interest, and then you adopt the overall valuation. Okay. Okay. Now, next point, adjustment for lack of liquidity to reflect lesser availability or ability of ordinary shareholder to initiate the sale of entity to realize the overall investment. Like if you're holding only 2% or 3% and somebody at the controlling level is holding larger percentage, can you just sell your 2% or 3%? No, and you can't even sell the entire company. And hence there are concepts of tag along rights, etc. Okay. The fourth adjustment that typically we do is adjustment for cumulative dividend, which typically is entitled for preferred stockholders. On the other hand side, equity stockholders, they don't get right to the cumulative dividend. If you don't get dividend, that's fine. If there is no profit, you are not going to get a dividend. But the preferred stockholders usually get the cumulative preferred stock dividend. These are minimum 4 differing economic and control rights for which we believe that the adjustment is necessary. Let's move ahead. Technique 2. So valuation techniques within market approaches are based on concept of comparables. Assuming that the value of an asset or let's say line of business or company can be measured by comparing the asset under valuation to similar assets for which the market price is available. For the purpose of measuring the fair value of equity instrument of an investee, investor can consider the fair value of equity instrument of similar entities, that is comparable company peers, for which market price is available. So technique 2 is comparable company valuation multiple derived from quoted prices, that is trading multiples. Okay. Now there are two main sources of information about getting prices of comparable company peers. First is quoted prices in exchange markets. For example, in India, we have two stock exchanges, NSE or BSE. So we usually capture prices from these stock exchanges. Second could be observable data from transactions such as mergers and acquisitions. Okay. When such relevant data exists, an investor might be able to measure the fair value of an unquoted equity instrument by reference to multiples derived from prices of publicly traded comparable company peers, or by reference to multiples derived from observable data from merger and acquisition transactions involving comparable company peers. When using transaction multiples to measure the fair value of unquoted equity instruments, investor must consider those transaction multiples sometimes represent sale of controlling interest. That is the number, the value with the control premium. In that case, obviously, some adjustment is necessary. So the fair value of investors' unquoted equity instrument must, however, be measured using the value which is on a non-controlling basis. So as a result, if the investor concludes that the observed transaction price includes a control premium, the control premium included in the associated transaction multiple must be excluded when measuring the fair value of individual unquoted equity instruments. Then investor, you as an investor must also follow similar thought process. If the transaction multiples included any premium reflecting, let's say, higher degree of control or a significant influence. So typically when you if a multiple represents a transaction when you have acquired more than 20%, we say that it's a high degree of control because then you can exercise the significant influence. Like if you own more than 25%, then special resolution cannot be passed without your acceptance. So it as good as become, the unanimous resolution in that case. So to that extent, some iteration and some calibration is necessary. Now, whether investor uses trading multiples or transaction multiples, the fair value measurement of unquoted equity instrument consists these steps. And I have written 4 steps. It's the 4-step model. What is step 1? Step 1 is first to identify the comparable company peers. Second step is to select the performance measure that is most relevant in assessing the value of the investee. That is, this would typically be by reference to measures such as should you use the earning multiple, or should you use the book value multiple, or should you use the revenue multiple. And once that performance measure is selected, derive and analyze the possible valuation multiple, and then select the most appropriate one. So after you did this exercise, then you say, no, it's a more suitable technique. The revenue multiple is better than, let's say, P multiple, or EBITDA multiple is better than revenue multiple, and likewise you can. That's the second step. Then we will go to the third step. In the third step, we are going to apply the appropriate valuation multiple to the relevant performance measure of the investee to obtain an indicative fair value of the investee's equity value or investee's enterprise. So the multiple is observed and then you apply to your revenue or multiple is observed, you apply to your earnings or your EBITDA. And then finally comes the step 4. Make appropriate adjustments. Very important. For example, sometimes you have to, do adjustment for lack of liquidity, to ensure comparability between unquoted equity instruments held in the investee and equity instruments of the comparable company peers. Okay. So these are typical 4 steps that we perform. Maybe, I want to discuss each of these 4 steps in detail, but maybe I'll take a pause for a minute. Look at the steps and think yourself, what would you do when you have adopted the market multiple method? And then imagine you doing a valuation of, let's say, one of your clients, unlisted client. Your client could be a software company, could be a retail outlet, could be a manufacturing organization, could be a service organization. Let's imagine you doing the valuation of your client. And then imagine how would you perform each of these steps. And then I will give you my take on each of these steps. Okay, maybe we'll invest, let's say, 5 to 10 minutes on each of these steps going forward. But think first. Your thinking is more important. So think, and then I'll discuss the way I do it. Did you get chance to think through about your client and how would you perform the valuation? Did you get a chance to think through about identifying the comparable peers? Like somebody in the software organization, one of the comparables that you chose. Did you choose directly Microsoft and Adobe as your comparable company peers? See, they must be comparable in the first spot. Now, obviously, listed companies are conglomerates, which means they represent not only one type of business, but could be multiple types of business. But I'll tell you example. And obviously, I'm going to speak either in international context or Indian context. But let me first speak in Indian context, as I feel because of the geographical proximity, you are well aware about some of the Indian companies. And let me quote examples from different industry. Let's say in India, we typically have large IT companies such as Infosys, TCS, Wipro. Now, these are IT service companies. Now, these companies are software companies, but these companies are or may not be always comparable for an unlisted company that you are valuing. Your company could be a product IT company, and hence comparable multiples of service companies should not be used. Comparable multiples of uh, only service companies can be used if you are valuing service companies. Comparable multiples of product companies should be used, such as maybe Adobe or Microsoft, if you are valuing product company. Similarly, if you are valuing, let's say, automobile companies, which automobile ecosystem you are valuing is more important? Are you OEM, or are you a brand owner, or are you supplier to OEM? And then accordingly, you need to understand exactly whether the company peer that you have selected is really comparable or not. So when valuation multiples are used, the aim is to identify companies that are comparable to the investee being valued in terms of their capacity to generate cash flows, the expected growth in those cash flows, and uncertainty associated with the timing and amount of those cash flows. So obviously, in order to limit the potential adjustments to selected valuation multiples, in most analysis, however, comparable company peers are defined to be other entities that are similar to investee in terms of business activities, market served, size, and geographical location. The definition is based on the assumption that entities in the same sector, or the entities in the the similar segment are usually they are comparable. That's the kind of the basic assumption that we have. Let's go to the second step. What is the second step? Second step is select the performance measure that is most relevant to assessing the value of investing. Now, selection of an investee's most relevant performance measure will depend on what? It will depend on uh, the business of the investee. For example, is it asset light organization? Is it asset heavy organization? If it's asset heavy organization, it's okay to use the book value multiple. If it's asset light organization, which means even your premises on a rented basis, so you don't provide for depreciation because you don't have owned premise, but you pay rent, which is a cash outflow, depreciation, non-cash outflow. So some of these comparables are quite challenging. And then there is a possibility that your company has lower margins because you pay rent, and the other company has higher margins because it owns the asset. But to own the asset, there was a significant cash outflow that it has made. There could be a term loan, and then they are serving interest, but you are not serving interest because there is no term loan. So then in that case, is it okay to select, let's say, earnings as a comparable multiple? May not be. Maybe you have to rely on EBITDA multiple or a revenue multiple, because the earnings are differing because of the differing capital structures, or because of differing business model. Business models are same, but because of the asset light structures. Anyway, now let's come back and let's look at the third type. There are three common types of multiples. Usually, we look at the industry specific performance multiples, the benchmark multiples, and then the forward looking multiples. So I'll tell you some of the multiples that we heavily use. We use earning multiple, we use book value multiple, and we use revenue multiple. Now, earning multiples are such as, like EBITDA multiple, CBIT multiple, PE multiple. That's what we use. There are different levels of income. Sometimes at a MIS level, we also classify something as CM level 1, CM level 2, and we tend to use those multiples as well. And then finally, you may also need to perform, adjustments to these multiples. And we typically apply those adjustments in terms of size, in terms of revenue and asset, the level and rate of growth of earnings, the diversity of product ranges. Then the fourth is the diversity of the quality of customer base. Then maybe level of borrowings, and particularly when earnings or revenue multiples are used. And their locations, for example, where comparable company peers are from developed markets, and then you are valuing a company in an emerging market, then obviously, some more adjustments are necessary. Then normalization is necessary. So performance measures might need to be normalized. Normalization of the performance measures might include elimination of exceptional or non-recurring transactions. So for example, if your current year revenue is significantly higher because you have received, let's say, one of the high orders, the real question is that can you get similar orders on a recurring basis? And if answer to this question is no, then you must normalize the revenue. You can't just say this year, my revenue is high and I'm going to perform valuation of my company on the basis of this higher revenue. You need to identify maintainable revenue. You need to identify maintainable EBITDA level and maintainable profit margins. And in order to reach from current level of measurement, like revenue or EBITDA, to a maintainable level of revenue and measurement, if any adjustment is necessary, you must do so in order to normalize the conclusion. Okay. Okay, so I think, like I said, I can go on, speak on this multiple method, but my primary interest is to explain you through examples. So I'll take a pause here on the market multiple method. I hope, the theory that I have given you is more than sufficient in order to apparently understand the market multiple approach. And now I'll go into once again the cash flow approach or the income approach. Okay, so let's move ahead. Income approach. And we are going to discuss here on the DCF, that is discounted cash flow method. So we have 4-step methodology. The first one, I am going to debunk the VC approach. Okay. VC typically says that we are going to use the thumb rule, like I'll value product companies as 5 times of revenue, service companies as, let's say 1 time of revenue, accelerator companies at, let's say 2 times of revenue, or 3 times of revenue. Thumb rule that they use, VC companies. And they say, I'm not going to rely on the cash flows. But ultimately, when the crisis happened, everyone rests on the cash flows. So please trust that. Trust me when I say this. The fair value conclusion we cannot undersign by using the thumb rule, or by using such kind of VC approach. It may be good for them for the deal making purpose, but it's not really good for us when we do the fair valuation exercise. So in that context, the VC approach is debunked. We can't just say that your value is 5 times of revenue, or 5 times of, or 5 times of EBITDA, or 10 times of EBITDA. That's not how the valuation science works. It is not on assumed or thumb rule basis. Otherwise, it's so easy, right? That you apply thumb rule to everyone without properly considering features and characteristics of those organizations. Second, we are going to discuss on the beta. I'll speak less on beta because, it's more of a detailed technical, understanding that is necessary. But I'll tell you all in all what is beta. Beta represents responsiveness of the change in stock price of the company under valuation vis-a-vis the change in the stock market. So when we say that the stock market is doing good, it's going up, but real question is how your company's valuation is going up or down when the stock market is going up. Whether your company has a positive beta, whether your company has a negative beta, whether value of your company, the beta of your company is less than 1, the beta of your company is more than 1. These are relevant questions. These are relevant questions. Okay. And beta forms a part of the discount rate. So inside the approaches, one of the approaches income approach. Inside the income approach, the one of the technique is discounted cash flow approach. Inside the discounted cash flow approach, we use cash flows and discount rate. Inside the discount rate, we need one of the input, which is beta. Okay. And obviously, all these inputs matter to the valuation. So all these inputs must be very scientifically calculated. Obviously, today we don't have time to in detail understand how we calculate beta, but I'm very sure you can Google, you can understand. What is more relevant for us to understand is how we calculate beta and how it impacts the overall valuation. So beta, like I said, you need to observe from the stock market of different companies. you need to unlever it on the basis of capital structure of those companies, and you need to relever it on the basis of capital structure of your company. And once you have that beta, you will utilize that beta in CAPM model, capital asset pricing model, in order to calculate the discount rate. If you are using free cash flow for firm, you will utilize weighted average weighted average rate, okay, WACC, as weighted average cost of capital as a discount rate. If you are using free cash flow for equity holders, then you will use KE, that is cost of equity, as a discount rate. Okay. Now, valuing global unlisted entities uh, is another point, third point that is relevant to us. Can you, sitting in Nepal, do valuation of Indian companies? Answer is yes, you can do so. You can definitely do so for the deal making. Now, obviously, we are not discussing about here, the valuation for the compliance, because for compliance, you need a license, right? You need an authority to sign report for Indian compliances, which you may not have. But can you do valuation for US entities, Indian entities, European entities, Singapore entities sitting back in Nepal? Answer is yes. For deal making, definitely you can do so. So, because of the democratization of the global data and the talent spread across the world, today you sitting back in your city can definitely serve clients in Singapore, in Europe, in USA. Are we doing it? Yes, we are doing it in India. We are doing it in USA. We have company in USA. We are serving European clients. We are serving US clients. We also have company in India. We are serving Sri Lankan clients. We are serving Singapore clients. Now, obviously, we don't have the live current Sri Lankan clients, but basically, the passing remark which I want to make is you can do so if I can do it sitting back in India, sitting back in USA. You can do so sitting back in Nepal. So, please think about it. You definitely can perform global valuation. So don't look at adopting to valuation profession as a domestic profession or a geographically restricted profession. You need valuation for deal making, for derivatives, for M&A, for insolvency. We have analyzed, all these 9 areas of prospective work. For impairment, for many areas you need valuation. So you can definitely perform the global valuation. And then while you do so, when you adopt different approaches, you might have to calibrate, you might have to adjust, and you must do so maybe by deploying, let's say, Monte Carlo simulation or some better techniques. Now let me spend some more time on the cash flows. What are the relevant questions when we are looking at the base year and estimating the revenue? Are your earnings positive? If the earnings are positive and normal, what is expected inflation in the economy? Because is the growth coming out of the price inflation, or whether the expected incremental revenue is coming out of the volume growth? If it is coming out of the price inflation, then it means that you are facing, your margin should not be significantly great. Because if your margins are significantly great, it means will continue to capture the volume growth, which is not visible, right? So you need to analyze it. If earnings are positive and normal, what is expected real growth rate in the economy? That is a volume growth. What is expected growth in revenue for entity that you are valuing? What does this entity have significant and sustainable advantage over competitors? And hence you have higher margins, which is represented through the brand value. So the base year and growth questions are this. You must answer these 5 questions at least in order to, ensure right judgments around the base year and growth. In terms of margin, if the earnings are negative, is it because the entity is into cyclical business? Is it one time or temporary occurrence? Is it because entity is just starting up? And for terminal value, you must also look at, what is the current debt equity ratio? What is the debt ratio expected? Are you going to pay off your debt, or are you going to lever more by getting more debt? Because higher the weight, higher the debt, higher the impact on the WACC. Lower the debt, lower the impact on the WACC. Basically, if you have higher equity component, your WACC rate will be higher. If you have higher debt component, your WACC rate will be lower. But if you have higher debt, then you will also have lower free cash flows because you have to pay the debt. If you have lower debt, your free cash flows will be higher, because whatever you earn, obviously you pay less towards the debt and then you retain the cash for the equity shareholders. What is the reinvestment rate? What is dividend payout? Can you estimate the capital expenditure and working capital requirements reasonably? So these are all relevant questions that you must answer while you are estimating the cash flows. Let's move ahead. Now for the decision matrix, what is the type of model that you should select? Is it a discounted cash flow model or is it an option pricing model? Then should you use the current earnings, or whether current earnings are subject to some exceptions and extraordinary events, in which case you must use the normalized earnings? Are you applying and calculating the free cash flow for firm or free cash flow for equity holders, or are you going to use the dividend discount growth rate model like we discussed? And then when you are projecting the cash flows, should you do that projection for 0 to 5 years, 5 to 10 years, or more than 10 years? Can you really estimate your cash flows over 10 years reasonably? And if you can't, then you should not do the long-term cash flow projections. It will only augment and bubble up the valuation, right? Okay, let's move ahead. Now, when we are looking at the discount rate, the risk-free rate, should you use the government 10-year bond or 30-year bond? How can we capture the country risk? Then if the, let's say the currency is the USD, should you apply the Indian government bond rate, or should you apply the Nepal government bond rate or the Euro government bond rate? Typically you use the bond rate with respect to the cash flow currency. So if the cash flow currency is USD, you must use the risk-free rate of the US government bond rate. Then while you are calculating the beta, should you use the 1-year beta, 2-year beta, or 5-year beta? Typically we use 2-year beta. Okay. Under the scientific process of first observing the beta, unlevering it, relevering it, and then capturing it in this particular calculation in order to calculate the cost of equity. Now, typically how startups look. For startup revenue, these are the stage 1, which is the development stage, where revenues are nil and the earnings are negative. Then in the second phase, revenues are positive, but because of high R&D cost and high marketing, your earnings are negative. And then comes the third stage, where the revenues are growing, but at a less accelerated rate, but earnings are positive. Okay. And with this, now we are going to go into a case study, because I believe that things can be learned well if we learn it through a case study than learning it only through theory. I hope my dissemination on detailed income approach and detailed market approach has helped you until now to understand it theoretically. I'm now going to go into a case study on one of the Saudi organization. The name of the company is Aramco. Aramco is listed on Saudi Stock Exchange, and it is one of the highest producers of the oil in the world. It has a rich oil reservoir, and a majority of the economy's GDP, Saudi economy's GDP, comes from Aramco. Aramco is government-owned organization, and as all of you are aware, Saudi is not a democracy; it is autocracy, right? Once upon a time, even Nepal was autocratic country, and I'm very sure that now you are now going towards the democratic nation like India is. But obviously, that also impacts the overall valuation. And we are going to observe all these macroeconomic factors while we perform valuation of Aramco. By the way, this is not the current valuation of the organization. This is the valuation that we did when Aramco made its debut on Saudi Stock Exchange in December, after raising 29.4 billion through its IPO by selling only 1.725% stake. It overtook Microsoft and Apple to become most valuable listed company at 1.88 trillion. Aramco versus listing, it's still on the card, but not in immediate future. Let's move ahead. And first, I'm going to discuss relative valuation. That is, first we're going to discuss the market multiple valuation, and then we will discuss the free cash flow method, the income approach. So first, let's apply the market multiple approach, and by utilizing the market multiples. So we have analyzed the data of 373 entities worldwide in oil and gas. So the data that we captured was the name of the exchange on which the company is listed, And then these 373 entities were represented by 57 public companies, 286 private companies, and 30 oil assets. Now, this becomes the level 1 input, right? These are the inputs, observable inputs. And we finally captured most of the data from the public companies, because the data of private companies, we found it to be less reliable. And often, because all companies work in very confidentially, uh, we were not able to really capture the data about the private companies. So what all data did we capture? We captured 9 data points, which are financial data points from the latest annual financial statements. We looked at its market capitalization. I mean, all those 57 companies are, by the way, for all 57 companies, we captured these 9 data points, which are market capitalization, total debt, total cash and short-term or liquid investments, total revenue, EBITDA, EBIT, net income, interest expense, and equity. Then we also captured some non-financial data points from annual financial statements, which are 4 data points: total proven oil reserves, total probable oil reserves, total oil equivalent production, and closing reserves. Then we went ahead and then we observed EBITDA, total revenue, and oil production on a quarterly basis in detail. And apart from that, we also collected 2 additional data points on a credit rating for each of these organizations in their foreign currency and in local currency. So all in all, we had 373 entities at the beginning, for which we collected the name of exchange on which these were listed. We had data of 57 public companies and 286 private companies and 30 oil assets. We collected 9 financial data points, 4 non-financial data points, 27 historical data points on a quarterly basis, and 2 credit rating points. So all in all, we collected 9 plus 4 plus 27 plus 2, that is 42 data points for these 57 public companies, which are basically, we have information of now 2,394 data points in order to begin with the valuation of Aramco's valuation. Let's move ahead. While we did capture all those 42 data points, we finally said that we are going to process these key 14 values. What are these key 14 values? Enterprise value, invested capital, PE ratio, price to book value, enterprise value to sales ratio, enterprise value to EBITDA, enterprise value to invested capital, enterprise value to proven results, enterprise value to oil produced, return on equity, return on invested capital, operating margins, debt to equity ratio on the basis of book value of debt and book value of equity, debt to equity ratio on the basis of market values of debt and equity. And finally, we said, out of these 14 values, we are going to now focus on more relevant values to us, which are 9 key ratios. And out of 57 companies, we eliminated the outliers and we said we are going to focus on major 26 listed companies. So from 3,000 plus data points, we finally said now we are going to focus only on 2,034 data points, which are relevant to us as valuer. So that's where we are passing a judgment. We initially passed a judgment in selecting the data point and data sets, where we opted only for 57 listed companies. And from that, we again passed a judgment to narrow down our sample, which is more relevant to us, to 26 listed companies. So these are 26 companies which are visible on your screen. And these are 9 different relevant data points for each of these 26 companies that we captured. So we captured EV, then invested capital, PE, price to book value ratio, enterprise value to sales ratio, enterprise value to EBITDA ratio, enterprise value to invested capital, enterprise value to reserves, and enterprise value to production. So these ratios all we captured. And then we also looked at the statistical conclusions for these 26 companies in each of these 9 ratios: average, median, first quartile, and third quartile. You did not look at these numbers as of now. You can only observe the methodology that we captured. And by the way, I'm going to share my presentation with all of you after the session. So don't worry. Very soon you will receive this presentation before the next week, so that, hopefully you'll get more time to read over a weekend. And then you can once again go through my overall presentation. And like I said, I'm also giving you one bonus case study, that is Uber valuation, which I'm not going to conduct in today's session, but you will have it as a part of my presentation. So you will have two case studies, one which I'm conducting in today's presentation and one as a bonus case study for you. So the previous conclusion on statistical conclusion, we have captured it once again in this table. So average P multiple was 13.12. Average price to book value is 1.22. Let's say median enterprise value to sales is 0.89. So, this is what we observed from the market out of the cluster, out of the segment of 26, 26 different companies, which we believe to be comparable companies. And then we observed the data of the Aramco. So what was Aramco's net income? What is Aramco's book equity? What is Aramco's revenue for last 12 months? What is Aramco's EBITDA for last 12 months? Invested capital, proven reserves, and production. So these 9 elements we also observed for Aramco on the basis of its prospectus that we received. Because when it applied for IPO, we obviously had the latest 2018 data. And then on that basis, if you apply the first quartile here, same number you can see. See, this is 7.92 here, 7.92 here. 0.83 here, 0.83 here. Okay, 94.56 here, 94.56 here. If we utilize the first quartile and then we apply these conclusions on the Aramco's numbers, this comes the valuation of Aramco. And we used, the first quartile, we applied it on the first quartile, we applied it on the median multiples, and we also applied on the third quartile. Okay. Obviously, as a table, we don't get a perspective how these companies are valued and how the Aramco is valued as compared to all these 26 companies. Am I right? But if I show you like this, and if I tell you, don't look at the number as a number, look at the chart. And if I tell you that extreme right is Aramco in each chart, and all other left companies are these 26 companies. Now you get a perspective, right? On the basis of the first quartile, this is how your Aramco looks. On the basis of net income, it is significantly highly valued than all companies across the world, which means this company must be having significantly higher margins as compared to others. Maybe because of their drilling cost is low, or we don't know exactly what is the reason. But obviously, we need to dig through that information. Similarly, on the basis of proven reserves, this company is valued significantly higher. Rather, this is the highest valued as compared to others, which means none of the other companies have as much oil reserves as this company has, right? Okay, but this is valuation on the basis of the first quartile. Next, it is valuation on the basis of the median. And while observing this valuation, we also made certain notes. We realized that this company has a production rights of next 40 years, which can be extended for another 20 years. So we are looking at, horizon of next 60 years. But on the other hand side, there is a governance risk because government has absolute control over a company. In case of ExxonMobil, is it fully government-owned company? No, it's not. Or, if you look at some other companies here in the list, these are not fully government-owned companies. There is also control risk because there is a dependence on the local production. And there's a political risk because there's a monarchy. And you know what happened in Nepal when the monarchy change happened, right? When one king is replaced by another king, you are living example. You know exactly what anarchy can happen. And then you need to take right fiscal decisions, right monetary decisions in order to bring less chaos and more stability to the country. So I need not tell you, when the monarchy change happens, there is a challenge in terms of the supply chain, in terms of the security, and many other things. So that disruption might happen. So we believe that there is a political risk in that context, and that must get captured while we are valuing Aramco. And by the way, this is a chart on the basis of third quartile. But let's look at the median book equity multiple and median revenue multiple. For book equity multiple, Aramco on the basis of equity multiple and revenue multiple, it's similar to value of ExxonMobil and let's say Royal Dutch. That's how it looks. Apparently, okay, which is around 0.3 US trillion or so. But should we then adopt the book equity multiple as a right multiple or revenue multiple as a right multiple in case of Aramco? May not be. Okay. Which measure should you adopt is the right question for us. And we then said, no, the book value multiple doesn't at all reflect the kind of proven reserve that Aramco has. And even the current revenue multiple of Aramco, or sorry, if you apply the revenue multiple onto the revenue of the Aramco, it still doesn't make any sense because, all other companies will exhaust the reserves and ultimately it's Aramco. We will supply to entire world. In that case, we can't just apply the revenue multiple. So we said, okay, fine. I think the book value, equity multiple, and revenue multiple may not be right representative, at least not on the median basis. The net income multiple, should we adopt? On the basis of net income, the valuation comes to around 1.2 trillion. And on the basis of EBITDA also, it is coming to a little less than 1.2 trillion. Okay. So on the basis of net income, it is little over above 1 trillion. And on the basis of EBITDA, it is little less than 1.2 trillion. I think, the net income and EBITDA multiples are better measures of valuation. I'm not saying they're the best measures, but they're better measures of valuation. And then we said, is it really right to value this company significantly higher than all those companies? I feel yes, because Aramco's extraction cost that time in 2018 was $20 per barrel versus others' minimum extraction cost was about $40 to $45 per barrel. And hence, the valuation of this company should obviously be higher, significantly higher than all other companies in the world. Okay, let's move ahead. On the basis of production, the valuation that we did was coming to approximately 1.5 trillion. And on the basis of proven reserves, valuation was going to 6 trillion. We believe that the proven reserve is significantly high. And I think obviously we don't believe that the valuation of this company should be 6 trillion. But we believe that the valuation of this company should be around 1.5 trillion. It could range between 1.2 trillion to 1.5 trillion because see, in the previous slide, we said that on the basis of the net income, and they definitely have a competitive advantage because their cost of extraction is less. So we believe that their valuation should be 1.3 trillion minimum. And then we believe that on the basis of the production, its valuation could be 1.5 trillion. So in my opinion, that time we believe the valuation should be around 1.3 trillion to 1.5 trillion. And if you have to value it on the basis of proven reserves, it's crazy. We can't value it at 6 trillion. Then we need to bring adjustment for the country risk, geographical risk, political risk, and whatnot. So let's do that, right? Let's do that. Let's do that calibration. So then we said that if the company is located in Saudi, then there is a country risk. Let's look at all the companies located in the globe and then analyze where the country risk is already plugged in. And then, we looked at the Russia. All companies in the Russia, okay, these are, the companies in the Russia. 1, 2, 3, 4, 5. These 5 companies in the Russia we observed and we looked at their valuation. And then we looked at the average global valuation excluding Russia. So out of these 26 entities, if you remove these 5 entities, then it becomes the globe excluding Russia. So the average valuation, enterprise value for Russian entity was around, the 68,240 USD, billions, which is 68 trillion. But here, on an average, the number was different. And then we looked at these multiples. And what are these multiples? The global P multiple was 14.96, but Russian P multiple was 5. So why people in the globe are paying only 5 times of their earnings to Russian companies, but paying 14.96 times to companies located elsewhere? It's primarily because of, the country risk. And this is how for each of these parameters and multiples, we observed that there is a potential discount that represents the country risk. Okay. Because see, let's say for P multiple, you are getting multiple of 5 as compared to your global peers who are getting multiple of 14.96, which means the Russian companies are valued at only 33.41% of its global peers, despite similar cash flows, similar technical knowledge, similar commercial abilities and capabilities. Why? Only because the company is located in Russia, which means companies in Russia must be devalued with discount of 66.59%. And this is how, we captured the discount. And we said, okay, now what is the value of Aramco? on the P basis, PBV basis, etc., etc. And if we apply these multiples, then, sorry, if we apply these discounts, because for the country risk and geographical risk, then how much valuation we are getting for the Aramco? Then now on the basis of proven reserves, we had a valuation of 6 trillion. But then when we apply the discount, then it comes to the valuation of around 1.9 trillion. So we are seeing the maximum value multiple on the basis of even the reserve basis that we can give is 1.9 trillion. Okay. So we said that on the basis of previously the production basis, I can give you valuation of 1.5 trillion. On the basis of net income, I can give you valuation of 1.3 trillion. And on the basis of proven reserves with the countries embedded, I can give you valuation of 1.9 trillion. So basically my range when I'm using the multiple valuation methodology is ranging from 1.3 trillion to 1.9 trillion. But that's the entire one approach only, which is a market multiple approach. Now I'm going to apply second approach, which is a discounted cash flow approach. I'm going to apply now, look at the cash flows of the organization and then see what valuation comes when I apply this approach. So what was my methodology? My assumption that the valuation is carried in US dollar. Valuation is not carried in Saudi riyals, which is local currency. This is because almost all transactions by Aramco are entered in US dollar, which is a functional currency. If you want to look at the guidance on functional currency, please refer to IS 21 and you will get guidance on how to define functional currency. Then the inflation is equivalent to US Treasury bond rate, which is US TIPS rate. Treasury inflation protected security TIPS is a treasury bond that is indexed to inflation to protect investors from the negative effects of rising prices. The principal value of TIP rises as inflation rises. And then we have looked at the equity risk premium and the life and the tenure. So I initially looked at the promised dividend in the prospectus and they promised $75 dividend, okay, per share with the expected growth rate of 1%. And they agreed to pay it for 50 years. Obviously, 60-year total production is available, but these are the years of production left given the reserves and expected production. And then, these are certain observed inputs. So we analyze the risk-free rate. At that time, it was, 1.8% on 14 November 2019, which was US TIPS bond rate. Then the ERP for Saudi Arabia at that time was 6.23%, which was a mature market ERP of 5.44%, plus country risk premium was 0.79%. Then the beta observed was 0.5, and that's how we got the cost of equity, which is a discount rate of 4.92%. And then by using the Gordon's growth rate model, the Gordon's dividend discount model, we calculate the value of equity at 1.6 trillion. But the 1.6 trillion value did not represent the change of monarchy. What if the monarchy change happened? Then, we said that, okay, if the monarchy change, the probability of monarchy change, let's say if it is 50%, then the value will be, let's say 50. The probability of regime change is, let's say 20%. Then the value of equity will go down by 50%. Okay, this is what we said. So my value of 1.6 trillion, which is 1629 billion, 1.6 trillion into probability that the House of South rules is, let's say, 80%. So 1.6 trillion into 80% plus 50%, the 20% into 1.6 trillion into 50%. So that gives me the value of 1.4 trillion. So if you remember, on the basis of production, I gave you the value of 1.5 trillion. So again, on the basis of dividend model, again, my valuation is coming to somewhere close to 1.5 trillion after this particular adjustment. Let's go ahead. I performed the sensitivity analysis where I said that the probability of regime change is lower from 20% to 10% and 5%. But my valuation again is hovering from 1.46 trillion to 1.58 trillion, which is, like it is around 1.5 trillion. Okay. Then I applied the second model, but now I've captured the potential dividends and not the promised dividends. The potential dividends are not $75. They are now $111. For potential dividend, again, I did the same exercise. I came up with the valuation of 1.4 trillion. And obviously, you will get, my literature here. I'm just, moving a little quickly so that we also get some time for Q&A going forward. And I'll conclude this case study in next 5 to 10 minutes. So on potential dividends also, I get the value of 1.4 trillion. And when I perform the scenario analysis, sensitivity analysis, with the probability of regime change reducing from 20% to 10% or 5%, again, my valuation is hovering from 1.48 trillion to 1.6 trillion. So still we can say that the valuation is around 1.5 trillion. And finally, this is my last slide. When I apply the FCFE approach, which obviously will learn when you will go deeper into valuation science, where the operating income is 213 billion, and then there is a tax rate, there is expected growth rate. So you basically, after applying all this, you finally calculate the free cash flow, and you apply the cost of capital on free cash flow. Okay, here, in order to get the overall value. The value of equity is coming to again 1.6 trillion. And if you apply the probability of regime change of 20%, and if the regime changes, the value dropping by 50%, again you get the adjusted value at 1.5 trillion. So in the DCF approach, we, in the discounted cash flow approach, we got the value of around 1.5 trillion. Okay. So let me give you the summary here. Just a second. In the income approach, net income, we got the value around 1.3 trillion. Then in the production basis, we got a valuation of 1.5 trillion. Then on the proven reserves with the control risk, we got a valuation of 1.9 trillion. Then on promised dividend basis, we got the valuation around 1.5 trillion here. Okay, 1.5 trillion on a promised dividend basis. Then on potential dividend basis, we got again valuation around 1.5 trillion. And on again the cash flow, free cash flow basis, we got a valuation around 1.5 trillion. So I think, the DCF approach and the multiple approach are reconcilable. The DCF approach is also giving us the value which is falling within the range of 1.3 trillion to 1.9 trillion. And I'll come back to my first slide. I'll tell you at what price, the Aramco was listed. Aramco was listed at a price of 1.88 trillion, which is 1.9 trillion. And if you remember, when I applied the country risk to the proven reserves, we ended up getting the similar valuation. Let me show you. I hope you can see my screen here. The actual listing was at 1.88 trillion. Our valuation on a proven reserves basis was around 1.9 trillion. So that's how, the market also responded. And it gave the valuation of 1.9 trillion. So, like I said, I'm going to give you one more case study of Uber valuation. The content is there. Okay. You will be able to see through this content when you will receive it as a form of PDF. But with this, I'll take a pause here and would conclude. So I'm going to stop sharing and going to hand over the content to the moderator, Sri Shruti Gupta. And if there are any questions, most welcome.
Yes, thank you so much for an insight. Am I visible?
Yes.
Okay. So thank you so much for an insightful sessions. Yes, there are the insightful session. There are a couple of questions. I'll just ask them. Give me a second. So the first question is, how do we value the contingent liability legal case pending before the court, tax and other, which may have a significant impact on the deal making?
We typically use the option pricing, where it's a probability of happening or not happening, but that's a complex procedure. I'll recommend you to use the Monte Carlo simulation. In Monte Carlo simulation, you basically create multiple scenarios. Like, for example, when we apply the Monte Carlo simulation, we create minimum 10,000 to 20,000 scenarios. And in each of these scenarios, we assume, okay, if it happens, then what will happen? The contingent liability is outcome, which is dependent on something. Let me draw an example here. My question to you, I think, Shruti, both of us can interact. A farmer, when sows a seed, can he estimate that, let's say he's sowing sugarcane, can he estimate how much sugar bags he can generate at the end of farming season? He can do so only when he knows that is he going to get water, whether there will be good rain, and the quality of land. Okay. and the availability of water is dependent on the dam, because dam will decide whether they are going to give additional outflow of the water or not. And the dam will open its gates only when the water falls, which means when the rain happens. So the outcome of the volume of a farmer, which is a dependent variable, is dependent on few independent variables. And one of the independent variable is the rain. So when rain falls, then the dam captures the water. Then if dam opens the first door, you will get so much cubics of the water, and then the water will be available. And then finally, the quality of land, which is also one of the independent variable, along with the water, along with the seed quality, which is also one of the independent variable, then decide that, okay, so much volume of sugar cane, so much volume of the sugar bags can be generated this year. And it also sometimes depend on last year, whether the same seed was sown, how much fertile this land is. Why I brought this example? Because the conclusion, the output is a combination of many dependent and independent variables. So mathematically, the contingent liabilities outcome is nothing but outcome of many dependent and independent variables. So through Monte Carlo simulations, you need to define x-axis, y-axis, A, B, C as different independent and dependent variables and simulate them in different scenarios. And once you get conclusion in each of those 10,000 and 20,000 scenarios, as a normal, I hope you know, all of you have studied some statistics in school or colleges, and you know a bell-shaped curve for a normal distribution. So when you plot these outputs, you will end up getting a normal curve, a bell-shaped curve, normal distribution. And then you say, my confidence level that this will happen. So 80% confidence in the bell-shaped curve happens at the middle. And then there are outliers. And then those values can be then identified to be value of a contingent liability. By the way, contingent liability need not be accounted for as per accounting standard. The relevant accounting standard is IS 37. You need to only disclose it. And if you can't measure it, then you only disclose it qualitatively. But if you can measure it, like I said, through Monte Carlo simulation, you say that the uncertainty lies with respect to the time and happening or non-happening of the event. But if it happens, then potential confidence level at 80% confidence level or at 90% confidence level, we estimate the value to be so much. So that's a framework for you to perform valuation of contingent liability.
Thank you so much. Very well answered. So there's another question. A gas company used to take deposit per gas cylinder of say rupees 1,000 when a new customer purchases a new cylinder. Now, after say 5 years, the company takes 1,500. Total customer are 10,000. Generally, company do not keep customer-wise deposit. If we are valuing the liability today, do we take the whole liability to be 10,000 into 1,500?
See, when each customer buys the gas, it's a deposit is a contractual obligation. And that contractual obligation needs to be analyzed in terms of contract. If let's say in year 2020, person bought the gas connection by paying deposit of 500, is he eligible for the refund of 500 when he cancels his connection or his connection is expired? Or is he, whether he possesses ability to ask for additional deposit, let's say of current rate, which is 1,500? I believe that typically, I mean, in Indian context, I'll answer, the deposit amount is definitive, is not uncertain, and you can ask for refund only of the amount that you have paid. And we don't only observe this refundable deposits in case of gas connection, we typically observe it in case of lease deposits. We observe it in case of land deposits when the lands are leased from industrial zones in India, like I stay in Maharashtra. So we have MIDC, Maharashtra Industrial Development Corporation, as a board which leases lands to to the manufacturers. Then all these deposits which are paid are refundable, but amount is not uncertain. So in Nepal, if you believe that if amount will also undergo change as per the contract, then obviously you need to estimate liability with the current rate. But I personally believe that deposits are contractual obligations and usually they come with a definite price. And then for each of these customers, you need to identify liability on the basis of their contract. I personally believe that you mentioned in your question, the liability is not recorded for each customer. I think when you go back into the contract and when you perform your due diligence, you will realize that the liability is individual obligation and not the collective obligation. So though it may be presented as a collective single number, at the back end, the deposit register must be maintained. Like we maintain the fixed asset register, and on the face of balance sheet, we get a single value of building or a single value of plant, but at the back end, there's a fixed asset register, which maintains component-wise details of each asset. Similarly, for a deposit on the face of balance sheet or on the face of financial statement, it could be collective single figure, but at the back end, it should be, a detailed register maintained, and hence a value associated with that customer should only be refunded in the future.
Thank you so much. So there are a couple of more questions.
Sure, please go ahead.
So the next question is, can we take year 2020 as base year for Apple iPhone since Apple has a steady growth despite COVID-19 in global market?
Let me ask you this question. What change you see in Apple iPhone? Okay, let's look at this. This is my Apple iPhone. Okay, yeah. This is iPhone XS Max. You have your iPhones. I think most of you are having iPhone. What is a significant change in this iPhone? From XS Max to iPhone 11 to 12 to 13 or 14. Is there a significant change? Apple is struggling for a technological disruption. The majority of the Apple revenue, if you go into the revenue segmentation, historically, their major revenue came from iPads and new models of iPhones. But now the revenue segment had changed. Now their additional revenue is coming through cloud, through applications. Okay. And over the period, Apple has also realized that these phones and these devices work so beautifully that people are not exchanging them every 2 years or 3 years. I mean, obviously, there is a class of people who will continue to buy iPhone every year. That's a luxury segment and it's an ornament. It's a jewelry. Okay. It's not a utility module. But there are people like me, for example, I buy iPhone every 5 years because for me, it's an asset which depreciates at 20% rate. And I think, Shruti, you are also saying yes. So I think you also believe in the same thing. So a real question is, a base year 2020, can it be base year? I feel no. I feel 2023, the current year, should be a base year because they did not do something significant in this year, and I don't see they're doing significant great even next year unless they bring up. I mean, see, I'll tell you what happened last year. They brought glasses, Apple glasses. Everyone thought that a combination of Meta and Apple glasses is a great combination and it is going to disrupt market. It is not going to disrupt market. You know why? Because people are not going to buy glasses worth 3 lakhs. People are not going to buy glasses of even worth 1 lakhs unless a price of Apple glass becomes available to common man, or if the utility is matched with the price, then and then I would say the base year is changing. So we all are waiting for low hardware cost, low software cost. And then I would say, okay, Apple is bringing up something which is an iPhone event. When, long back, they had iPod when they did the disruption in the music industry. So I would say that was a base year. But then they launched the iPhone. Since when they launched the iPhone, that became the base year. But now after the COVID, then they launched iPad. Then that became the base year. But now when they launched Apple glasses, it is not a base year. We are waiting for something like that to happen. Otherwise, I think, the current year can still be the base year. Don't use the years from the COVID pandemic as base years because, they were impacted by supply chain. They were not represented by good manufacturing lines. Even Apple faced few questions in the Ireland and there was a Euro tax penalty that was discussed. If you're not aware about the structure of the Apple company, it has surplus cash available. And the surplus cash of the company is more than the GDP of our country, India. Okay, so Apple is altogether different case. And it doesn't pay tax, it parks all its cash in the Ireland. So, it has that tax benefit. And one of the investor of the Apple said that you are not able to generate good returns for me by keeping cash in Ireland. You bring cash to USA, pay the tax and buy back the shares. So you please Google on this particular scenario as well. So obviously it could not have been one line answer because you spoke about specifically Apple. I had to speak on various factors in order to answer your question. I hope I was elaborative enough to answer your question.
Yes, thank you. It was an elaborative answer. So I'll carry on with the questions. Next question is, which valuation approach could be applied for continuously loss-making company?
The real question is why there is a loss. Is it because R&D cost is funded? Is it because marketing cost is funded? What is the reason behind the loss? Is it because the business model is flunked? Then obviously the valuation is nil. But there are cases where you can't measure a success with, unfortunately, artificially humanly created period of 1 year. Like we believe, like for example, we celebrate a birthday. Why we all celebrate a birthday? Because we say completion of 1 year, that is 365 days, is a milestone. But in case of a life cycle of an organization or an entity, 365 day may not be a representative of a milestone. There are different life cycles. Like we as a human grow by 1 year, but companies outgrow in cycles and not in years. So there could be companies like OpenAI where you keep on investing in R&D and AI. And that's where there is a loss making. I mean, we call it as a loss because we prepare financial statement for a year. If we don't prepare financial statement for a year, and let's say we say period is for 5 years, then it's no more a loss making company. Over a span of 5 years, if we say it's a 5 year is equal to 1 period, it's not a loss making company. But to answer your question, when we are analyzing these R&D driven companies or market penetration driven companies, such as let's say Byju's in India, or let's say Zomato in India, which is a food delivery organization, or Swiggy, or let's say Uber or Ola, which are aggregators. These companies are putting investors' money in penetrating the market. So upfront, accounting standard doesn't allow you to capitalize it, and hence you must expense it out. And because you expense it out, there is a loss. So basically, that's the thought process. But when you do the valuation, you need to look at the overall period and not only 1 year as an accounting period and then call it a loss-making organization. When are you going to achieve the break even? So how you do the valuation? You go to the unit costing. You analyze the variable cost. You analyze the gross margin at gross profit level, EBITDA level, and whether the company is profitable at a gross profit level. Yes. If for each delivery of Zomato, company is earning money, it's a good company. But in order to penetrate in the market, they say, okay, we are giving additional discount for acquiring the customers. Now, today in India, I have Zomato app and Swiggy app. But now any Tom, Dick and Harry is also, in the market creating aggregators, food aggregators. Am I downloading those apps? No. Why am I not downloading those apps? Because I'm already, my customer stickiness, my customer loyalty now is already with the Zomato and Swiggy, and they will give me the notification even at the 1 a.m. in the morning. That and that's how they keep the customer touch point. So I think these companies, loss-making companies, must be analyzed differently. You still value these companies by looking at the cash flows, but cash flows must be looked at different level. Analyze these companies at a gross profit level, EBITDA level, and wriggle down, and then it's okay. See, choosing to invest in marketing is for customer acquisition, and there could be some adjustment that you can make. When Zomato acquired me as a customer, for accounting it's an expense, but they know that now this customer is going to be with me for next 10 years. So maybe for valuation, I would say I will capitalize it only for valuation and then depreciate it or amortize it for next 10 years for my understanding. And then these companies no more look to be loss-making companies. So it's a different science, similarly applicable to Tesla, similarly applicable to all new age companies.
Thank you so much. So moving on with questions.
Sure.
The next question is, How do you determine the reproduction cost versus replacement cost in the cost approach?
Typically, we apply the cost approach for intangibles or for asset heavy organizations where tangible assets are great. Reproduction cost means the cost that is necessary for you to recreate something. For example, if, like, for example, in our organization, we heavily invest in softwares. So we are our own software team. There are front-end developers, back-end developers, testers. So whatever software that we have, let's say proprietary software that we have, was built over a period of, let's say, last 5 years. So I paid them salaries. But the salaries I paid them in the first year and salary I'm paying today, those current costs are different. Now, reproduction cost means if today, if I have to create that particular source code of the software, how many people do I need? How much is the time effort? And how much is the today's salary level that I will pay per month? And then how it translates into the overall cost. That's a reproduction cost. Replacement cost means if instead of using my software today, if I have to buy somebody else's software, if instead of using my car today, if I have to buy somebody else's second-hand car, that's a replacement price. If somebody comes and says, Parag, what is the value of your car? I would say, I bought this car, 5 years back and then depreciated value is this much. But that's a book value. Now, if you ask me what is the reproduction value of your car, so I will say, no, I can't produce the car. I'm not a car manufacturer. So for car or for tangible assets, I can't refer to a reproduction cost. For software, I can refer to reproduction cost because I can create that one. But for car, I'm not a manufacturer. So I will say, what is the replacement cost? So I'll go to, some of the online platforms. I would say, okay, now if I have to buy this car, what is the value for second-hand car? It's a replacement value. So, there's a subtle difference between the reproduction and replacement. Reproduction means the time and effort needed for you to recreate the same thing at a current price level. Replacement means it's a substitute value for an asset in the same condition.
Thank you so much. So moving forward with the questions. What are the limitations of cost approach when valuing unique or specialized properties?
Unique and specialized properties have value combusted into future cash flows. And then those future cash flows may not resemble today's cost value. I think all of us as professionals, represent infinite possibilities of future. So is it okay to say that, let's say, you as a chartered accountant are valued on the basis of the cost that you have incurred to become a chartered accountant? Obviously not. Your true fair value is not represented by cost that you have incurred for your tuitions and for your books. It is represented by your future. And this is the key limitation for the cost approach. Cost approach should not be applied to such unique qualitative assets, whether it's a talent asset or whether it's a tangible asset, whether it's an intangible asset or whether it's a know-how. So I think, the key limitation is that cost heavily relies on the history and misses to look in the future.
Thank you so much. I am really intrigued by the way you have clubbed in your personal experience and real life experience while answering the questions. So these are the questions that have been asked by the participants. And it was a really insightful session, the way you have explained, the way you have given all the examples. So thank you so much. And as this marks the conclusion for day 4, and we extend a sincere thanks to a distinguished speaker, CA Parag Kulkarni ji, for his valuable insights. Thank you so much for such an enriching session. Dear participants, as we conclude with today's session, we look forward to meet you all tomorrow for day 5 of the online comprehensive course on valuation and valuation standards. Tomorrow will also mark the end towards this amazing journey of 5 days. So thank you so much and have a wonderful evening. Thank you.